Money Radio for a really great future. We're talking real money.
Once again, before we get to my incredibly well-polished and witty introduction to the program and the topic, we must implore you to call us at 855-935-TALK. And for those of you without a gigantic vocabulary, implore means beg. We're going to beg.
I think they said the uninitiated, but okay, that's fine. Yeah.
855-935-TALK. 855-935-8255.
That's toll-free. Toll-free.
Like every other call in America today.
Oh, okay. Well, I still like saying it.
When was the last time you made a long-distance call that you paid for?
Wow. I don't know, 20 years ago? I'm
It's
guessing.
been
No, I don't know.
long time.
Yeah.
Yeah. All those things are going to die with our little brains. Oh, well, probably for the best. Now, on to the topic. Today's topic is...
Speaking of things that die in your brain, yeah, this is it.
No, job security. We have incredible job security, and we want to thank you. Because without you doing stupid things, we probably wouldn't need to be here. But thanks to the fact that you just keep doing the same thing over and over and over again, and you know what that's the definition of, we're in good shape because you keep doing the same things over and over again. Let me give you a great example. Remember back when you used to work for Enron? Remember you Enron former employees? Or maybe Washington Mutual former employees, or Delta former employees, or WorldCom former employees, or you name it, former employees. How much of your retirement plan was invested in your company stock right up until the bitter end?
It's shocking. Honestly, when I read this article, I guess I get angry, and not, by the way, necessarily at the employees, because they're encouraged to buy the stock by the company. They are.
But they also delude themselves. They go, oh, I know my company. I'll know if it's going to be in trouble.
Right, because if you work somewhere, generally you like the company. Yeah. You like the CEO. And I get it, not everybody. But you've heard about SVB, right? Silicon Valley Bank and First Republic Bank. Mm-hmm. Because those are pretty recent. The other mentions Don gave were more like, well, Washington Mutual was 15 years ago. I think.
Yeah,
Enron
but you would have thought that we would have learned our lesson.
Not a darn thing. So you not only at those banks probably are losing your job or lost your job because and if that's not enough, you've got all the money that you had in the 401k in their company stock. Shocking numbers. Just read this today. It was about 20% of employees' holdings in the SVB 401k plan in company stock. Gone. Bye-bye.
Gone.
20%. Yeah, you're not getting that back.
And you don't realize it's going to be gone until it's too late.
Well, yeah. I mean, and right up to the end, you had somebody at First Republic telling people, no, good time to buy a good time to buy the stock after it's gone down like that. Well, yeah, I mean, I guess if you're buying low and want it to go lower, I mean,
I'm buying high and selling low.
Yeah. There you go. I mean, one employee wrote, my diet went from steak and caviar to cup o' noodles. A lot of people at First Republic saying they had paper losses of 50,000 or more. But I will say this again, and I went back and looked at Washington Mutual because that's very personal to me, because I had interviewed the CEO, Kerry Killinger, every year on television up to that year.
And he didn't tell you it was going to be in
trouble?
trouble?
The company. He didn't tell me, but they had $300 billion on the books. And when they went bust in 2008, 18,000 people lost their jobs. $400 million in company stock that people owned in their retirement plan, gone.
Wow.
Zero. Nothing. It gets worse. You mentioned Enron.
Yeah. Half
of the 401k plan was in company stock. The 401k plan was about $2 billion. You can do the math there. That's about $1 billion of people's retirement. So you not only lost your job, you lost your retirement too. I mean, it's just horrible. So what do I think? Because we've had this debate for a long time. I can remember our friend Paul Merriman saying it's okay for people to have 5% of their money in their company stock. And I said at the time, no, why would you do that? Because you're going to hold on to that to the end because you believe in that. If they'll fix it, they'll figure it out. Washington Mutual even had an offer on the table for $8 a share not long before they went bust, and they got far, far less than that. You still believe in the company. You're never going to get rid of that stock. I personally think if you have company stock right now, you should have a plan to get out of it.
Okay, but
look at your balance.
There's a big but here, and I like big buts. This is a big but. What if your company is giving you a really great deal on your stock? We're going to talk about that after the break. 855-935-TALK is our phone number, 855-935-8255.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
And again, our phone number is 855-935-TALK. You want some help with money? We're here to give it to you, and it will be help that is truly in your best interest, not ours. Before we go to a caller, Tom, the question I have, and I think a lot of other people have, did you get disconnected again? Oh, wow. Okay. Well, I'm going to continue. What if your company is offering you some sort of a deal on stock? You can get stock at a big discount. What do you do then? Well, it depends on the discount. If it's sizable, if it's, half off, you might want to take the stock and then, as Tom said, have a plan to unload it in the future in such a way that it doesn't have a huge tax detriment. But generally speaking, owning any individual stock is a mistake, but often owning your company stock can be a huge mistake, and it happens over and over and over again, and we think it can't happen to us, but the reality is it can happen to anybody. 855-935-TALK is our phone number, 855-935-8255. And Sharon, it's your time. Welcome to Talking Real Money.
Hi.
Hi, Sharon.
I like you guys. I've listened to you often as I'm going to my errands on the weekend, and you begged me to call today, so I'm calling.
I did. I begged. I implored. I begged. Thank you for actually taking me up on that. Appreciate it.
Well, not a problem. I've been looking forward to talking to you a while. I'm going to give you some background. I'm not the most savvy investment person in the world, although I have a bank marketing background. Doesn't mean much when it comes to finance.
No, it's a different skill set.
Yes, it is. And my portfolio, which used to be my husband's and mine, but is now mine, is with Securian Financial.
Securian,
and
okay.
It's pages, yes, pages and pages and pages of the various funds that I'm invested in. I believe that I have a rather low annual fee. It's a few $1,000s. Here's my question. Last year, the fund topped out my particular portfolio, which is part retirement and part brokerage, topped out at $570,000. That's all the investment money I have.
Okay.
It got down to $450 a few months ago. Because of any number of things that happened in the market.
Right.
So I called the agent who I get a 1 anniversary phone call from. And he explained that I should sit tight, that I shouldn't do anything. Let me back up a minute. I have a modest, my parameters are set so that I'm modestly willing to take a risk. And at this moment, I don't need the money, but I really don't want to see a $75,000 loss in a month. So
in a month?
I've been yes, in 1 month last year. Well, maybe 2 months.
Okay,
I can't remember exactly.
If I could, please, I'd love to ask you a question that really will tell me a lot about this Securian account, because they're so complex that really getting to the meat of the quality of the advice requires knowledge of what exactly it is that you're invested in. Do you have the name of any of the funds or products in which you're invested?
Well, I can give you two pieces because I have the papers in front of me.
Oh, perfect.
First, I will give you Domestic equity is 33%, international equity is 27%, domestic fixed income is 21%, international fixed income is 13%, alternative is 4%, cash equivalents is 2%.
Okay, what are the names of the funds?
Specific.
Yeah, more specific.
Oh, good luck.
Yeah.
You really want that?
I do. I love this stuff. I live for this. Go ahead.
All right, let's see. I'm getting to the page where it has all of the funds listed.
Okay.
I'm going to start with, do you want the IRA part or do you want the portfolio part?
Let's go with the portfolio part just for fun.
Okay.
Go ahead. I'm ready. I'm writing.
I'm looking, and the pages that I pulled out.
It's a lot of stuff there.
Oh, God, there's a lot of stuff. And unfortunately, you know what? I'm going to have to give you the IRA.
Give me the IRA.
I didn't pull the pages.
No, the IRA's fine.
Okay.
It's going to, whatever, I will know in about 30 seconds.
No,
Okay.
10.
10, okay.
Core fixed. Hi, both of you. Core fixed income, dynamic asset allocation, emerging markets debt, emerging markets equity, government funds AABXX, high yield bond, international equity fund, large cap fund.
All right. Hold on,
Now,
Sharon.
this is
You gave me
just one.
you gave me some. You gave me the symbol only on one. Do you have symbols on any of the others? You gave me A, B, E, X,
yeah.
X. Oh, good. Give me a core equity fund.
TR, L is in Larry, V Victor X. The dynamic fund.
Okay.
S, D is in dog, Y, A, X is in X. Can't think of a word.
That's right. Yeah.
Excited. You want more?
No, I'm going to look these up now. Hold on.
So
One
I
of them is
looked
a
up
T. Rowe Price.
TRLVX. It's the SEI Institutional
correct.
Managed
That's-
Trust Core
Oh,
Fixed
that's
Income
SEI.
Fund.
Okay.
Yeah. So, I mean, okay, so right off the bat, before we even get into anything else, this is an actively managed fund. This is expensive for a bond fund because it's 60.6. Actually, I'm seeing two. I see 0.88 here on this page. I thought I saw 0.66 earlier. But either one would be expensive for a bond fund where you can go buy Vanguard's BND for, I don't know, was it 6 basis points? I mean,
A tiny fraction. Yeah.
So and this, yeah.
And I'm trying to look up their fees here. Wow, their fees are buried on page 17 of their ADV. See, we were talking about that earlier, the fees being buried.
Hard to find.
Yeah, wow, look at all this stuff. Securian
Well, I
one
can
fee.
tell you how
Yeah, what do they charge you? Can you tell me?
I'm going to go to the page where the fees come out. And I'm really so sorry that I'm having to.
No, you're
struggle with
fine.
this.
Sharon, this stuff is, they specifically designed this stuff to be complicated. I'm looking at their Form ADV, and their fees start at 1.75 for their wrap fund, and then drop down to 1.1 at $500,000, and they don't go to 0.9 until $2 million.
On the high side. And
Well,
then,
Ed-
by the way, don't forget, then the other part of that is how much you're paying for the fund. So if you're
Right.
paying 1.7 plus 0.66, now you're at almost 2.5% that comes right out of your pocket into theirs before you even start doing anything.
And it doesn't show on my paperwork. I can't see any
Yeah,
of
well,
that. The only thing
I'm pretty confident because they have to be, unless they give you a special deal, they have to be pretty honest with the SEC. And for the first $500,000, the fee is 1.75% of your assets. And then after that, the next however many thousands you have is at 1.1. So your average fee is going to be 1.7 something. And then you got the fees on the funds, as Tom said, which brings you to 2 point something. So what you have is a very expensive advisor. And if he only talks to you once a year, he's ridiculously expensive and he's actively managed. So we will not like him much.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Now, of course, we are making some major assumptions about Sharon's account. We know it's with Securian. Because of the funds it uses and the structure of it, I'm guessing it is a wrap fund, a wrap account like the Securian One program. That's what I'm guessing, because those funds were not commissioned, but they were active, or they are actively managed, and they are expensive. And so Tom's point is that you're not just paying the 1.7, you're paying 1.7 plus the fees of active funds, which are higher than passive, or
and much higher. Again, and this is a very important thing. Actively managed funds, a bond fund that's charging somewhere depends. I guess it depends on who puts them in it, but either 0.66 or 0.88. Frankly, in today's world, is outrageous when you can buy basically the same bonds for 1/10 the cost. I mean, would you be paying $4 a gallon for gas or 40? I mean, it's a no-brainer to me. And they're going to say, SEI, well, we got smart people that are trading these bonds, Tom, that are making a lot of money. And I'm going to say, maybe you did, but you won't. It won't stay, because that cost is going to really it's going to tear down the returns, reduce the returns over the long haul. Yeah. So, you got to add all that up. It's expensive. Very
And one
expensive.
of the funds she has was that SEI Dynamic Asset Allocation Fund that is primarily equities. So they're trying to beat the market. It is primarily large company growth. So it's like the S&P 500. And yet, funny thing, year to date, it's underperformed the S&P 500 by about 2%. Long term.
And how much is the charging? How much
0.75.
Okay.
0.7, which is again on the high side. They kind of sort of sometimes match the index. Sometimes they underperform. The odds are, and we know this because we look at the numbers. Actively managed funds in aggregate underperform the indexes by a fairly decent margin over a pretty decent period of time, too.
On a very regular basis. And then the longer you hold that fund, the greater chance is it will underperform.
Yep.
Because they may have had a period where they did well for whatever reason, luck probably. But over the long haul, those costs and all the trading and all the rest of it drag the performance down. So I'm with you. I'd be looking at that carefully and trying to figure out what my future should be, probably without them.
855-935-TALK. Call us, and we'll try to help you deal with this, because the truth is, odds are your advisor is not as good as you think they are. I hope they are, but they're usually not. Joe, you're next. Welcome to the show.
Hey, good afternoon. Listen to you often. Never have called. I got a couple questions.
Go ahead.
Still there?
Yes, sir.
My first question is, I've got about maybe about $200,000 cash that I have a number of different investments. I'm a simple man, but a little bit in real estate, a little bit in a portfolio. I've got a couple $100,000 that I've just been reluctant to do anything with recently with the pandemic and whether or not the government was gonna take care of its business and stuff. But I was wondering, I see these online FDIC-insured CD rates, and I've been watching them creep up and up and up. And one in particular is Evergreen Bank, FDIC-insured, maybe a minimum of $1,000 and a maximum of a couple $100,000, and they've got a 12-month or a 13-month that's paying 5.5. Mm-hmm. And so I was thinking about, maybe buying a $50,000 worth of a CD, and I got online to do it, and I realized that they're all online. You can't go to the bank, and so I got a little bit nervous, and I thought, well, maybe I'll call those guys and see what they know about these FDIC-insured banks, but everything's online. What do you think about that?
That's why they can give you the high rates, because they don't have brick and mortar. But as long as they have FDIC insurance, they are absolutely safe if you stay under $250,000. 855-935-TALK. That's our number.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
Before the break, we were talking with Joe. We're going to talk with him a little more. But Joe said that he has a bunch of money in cash, and he has it in cash because he's been worried.
Yeah, he was worried about the pandemic. A lot to worry about there. Worried about the debt ceiling crisis. Sure, a lot to be worried about there. My question to you, Joe, is what are you worried about today?
That's keeping it in cash.
Well, that's the point, right? My worry is starting to subside, and I'm looking around at doing something with this cash. And so I was thinking, I might wade into some rotating CDs for a little bit with some of it. And there's always uncertainty. We all know that. But I just thought that holding on to some of my cash for a while might be prudent. People lose money every day, but I'm wading back in with this particular piece of money, and it's not play money, but I'm careful with it. And I think I started out with maybe 30 or 40,000, I don't know, quite a while ago, and it's slowly growing. And sometimes I dabble in the stock market a little bit with it. It's not structured. It's stuff that I can do what I want to do with,
and that may be the problem, Joe, is that it's not structured.
Yeah.
We're not big fans
Indeed.
of unstructured portfolios.
Yeah, I mean, that gets back to, and we'll let you ask your second question here in just a moment. But here's the thing. With all of your money, the money should have a purpose. The $200,000 is for fill in the blank, and maybe it's for future generation. I don't know what it's for. Then once you've established that, then you can say this much should be in stocks because the future is uncertain and they pay more because of that. This much is in bonds because those have been more stable, and this much is in like CDs because that's a guaranteed amount I'm going to get back. That's how you build the portfolio, so that the pandemic and the debt ceiling and I could give you a long list of all the other things, the election, Ukraine, we could go through China and slow down. There's 100 other things that are bad news out there. Those things do not matter to you if your portfolio is constructed properly. But what's your second question? We want to make sure we answer that.
Well, I don't know if you can comment on this, but someplace else I was looking was, do you have an opinion on the Phoenix Capital Group Holdings, LLC? They're a oil and gas mineral rights.
Run away as fast as your legs will carry you.
You're scared of the stock market and you're thinking of that? That is really the other end of the spectrum.
That is as scary.
Seriously,
we went to a financial thing in Phoenix. Tom and I used to go there all the time. In fact, we invented it, a conference, and we were at one where a host of a show who always had these guys on, who sold these oil and gas partnerships, was being screamed at by an audience member who lost everything in one of these oil and gas deals.
Right.
No, wouldn't touch them.
Right.
No way.
You guys carry on.
Thank you.
Thanks for the opinions.
All right,
see you
sir.
later.
Take care. Bye-bye.
This is
Joe is. There's no plan. There's no plan, Joe.
No. Yeah, exactly. Yeah, and he's right where so many of us are. Because to many people, investing is exactly what he just said. It's where the world is today. Therefore, my portfolio does this.
It's a game,
right? I mean, because it's a pandemic. I don't want to do it because it's a pandemic. I don't want to do debt ceiling. Folks, there's always those things. Sometimes they rise to the level of a pandemic. Sometimes they lower themselves to the level of a debt ceiling, which never should have gotten all the press it did anyway, but it did. Those things always, Don and I could rattle off 10 bad things that are happening right now. Isn't there a thing called inflation? Are we heading into a recession? I mean, blah, blah, blah.
I mean, we've got Putin moving nukes into Belarus.
Moving nukes into Belarus. Yeah, I mean, there's just all these.
There's always something to be afraid of.
You.
Yeah, and what's fascinating is that throughout history, There has always been something to be afraid of. And throughout history, there have actually been events that were truly horrific, unlike anything any of us alive, except for a tiny fraction of very old men, have ever experienced. We have never experienced what people in World War II experienced. Entire countries were destroyed, and guess what the economy did? It grew. It grew, and it grew, and it grew, and it grew, and it's so, the global human economy is massive, and it's grown for as long as we've been running around building cities and planting crops. 855-935-TALK is our number. We'll be back.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
And apparently we have to keep beating that dead horse, which is really a horrible saying when you think about it. It really is. You know, it's just how
well, 19th
century is that saying? I just
you want to take it to the Tesla times or something? Do a little different?
Yeah, that beat a dead Tesla. I wanted to say something. Oh, about Joe. Joe's call illustrates so clearly why most people cannot invest on their own.
Yeah, and we see this over, and we do for our clients. Don laughs because it's the same message every time.
It is.
And if you're a client, God bless you for tuning in and listening. But we do a quarterly review every, quarter, right? Every 3 months.
Really? We do a quarterly review every quarter?
I knew that wasn't going to come out right.
If you really were good at this, you just go ahead and do it monthly.
Yeah,
if you really cared, you'd do your quarterly review every month.
A lot of people join us online because they like us. And I honor that. It's nice. But the messaging, even though we're going to talk about slightly different things that happen in the quarter, but the message is always the same, which is
don't do anything.
Your portfolio is already built for what you're trying to achieve, how much return you're trying to get, how much risk you're willing to assume.
Don't just do something.
How
sit
soon
there
until you need the money. And if you think it doesn't matter, in Joe's case, just we're picking on Joe, because you're not alone.
No.
But let's just assume you did a moderate portfolio this year, 60% in stocks, 40% in bonds, right? That's up about 5%.
You're talking about the last, or just this year, the year to date? Year to date.
2023, that's it, yeah. 60-40, you're up about 5%. What's 5% of 200,000? That sounds like $10,000, right?
Better than most CDs, except...
Yeah. Oh, yes. We got to finish that little tale.
Well, here's
too.
the thing. It's one of the best ways to buy CDs is through your broker. And my brokerage firm is Charles Schwab. So I logged into my Schwab account to see which CDs I could buy right now and what the rates were. There is a 1-year Bank of America CD. You want brick and mortar? Bank of America. How much more brick and mortar can Bank of America be?
Go serious.
So I could walk in. I could walk into Bank of America. Well, wait, maybe not. Hold on. Through Schwab, I can get a 1-year CD for 5.25% for a year. Wow. Isn't that good? Yeah. But you know me. I'm such a Luddite. I have to actually physically walk into Bank of America to get my CD. So I'm going to go to my local Bank of America branch. I just went in online. I told them which branch it was and that I want to come down and get a CD. And it asked me how much I wanted to invest. So I said 12-month CD, $100,000. How's that sound? Now I'm thinking 100,000 or more, I'm going to get their best rate, right? Walking into the bank. 1-year CD, same thing they're selling at Schwab, 5.25. If I walked into Bank of America on Tuesday, because Monday's a holiday, to get a CD, I'm going to get 0.03%.
So 3/10 of 1%.
0.03%.
Excuse me?
0.03%.
But you can go online to Schwab.
That's $3 on $100,000.
You can go to Schwab and you get 5%
and a quarter
a year more
from Bank of America. 5.22%
What does that
more.
say?
I don't know what it says.
That?
And by the way, it also says here, if I want to take it out early, an early withdrawal penalty will apply. It's like, okay, here's 75 cents.
Oh, yeah.
It's like,
Wait. No, but okay, all kidding aside.
can you believe the difference?
Somewhat humorous.
It's totally
what you're
humorous.
saying is our customers were okay to rip off.
Yep.
Really? Because
Yep.
those are the people going in the branch.
Yep. It's what it sounds like to me, doesn't
what
it?
else is it saying? What else are you saying? If you're smart enough to log into your Schwab account and buy our CD from somebody else, whoa, you're going to make and by the way, I cannot find a better rate than that at bankrate.com. I can't find better than 5.25.
Hey, Morgan Stanley's got a 5.25 1 year. Ally Bank's got a 5.25 1 year. Securian Bank has 5.3. Bank of India, New York, which is an American branch of the Bank of India, 5.3.
For the life of me, I don't understand number one, I don't understand why you won't give your customers the same deal.
But again, though, what does this say? This says that if you have somebody who knows what they're doing.
Good point.
For example, if you had us and you said, I want to get a CD, well, we could go into your Schwab account and go, oh, look, we can get a Bank of America CD for 5.25. And you go, no, I think I'll go down to Bank of America and get it. I don't want that extra 5.2% per year. Uh-oh. You went dead again. Yeah. See, here's the deal. This actually has been very fortuitous. Tom has been having problems with the internet disconnecting his feed in our office because he's not on the hard wire now. For some reason, he's on the Wi-Fi, and the Wi-Fi is not that good. So he keeps dropping off. And it's funny, he's dropped off 3 or 4 times, but it's always been during news or commercial breaks. So we've been able to make it sound like he was here the whole time when he really wasn't. He was back and forth. So I just kept jabbering while he redialed and tried to reconnect. So right now he is I feel badly because he's frantically trying to reconnect and I'm just sitting here doing the show. But and again, here's the thing. You want to get those great CD. I could build a CD ladder right now at Schwab. And I could go. And the funny thing is we've got an inverted yield curve. So right now, the 3-month CD pays more than the 1-year CD. It's 3.46%. But I could build a 1-year CD or a 5-year CD ladder. And still, overall, even with 5 years only yielding 4.5%, I could overall end up right at about 5% per year on average. And then when that 1-year CD matures in a ladder, and this is the problem with laddering, you must be disciplined enough to not try to play a guessing game at the end of that term. So, and when a year is up, you take that CD and you go back to your brokerage account and you buy a brokered CD, 5 years, 5-year maturity, which keeps you with a nice average yield on your portfolio. If rates go up, great. You get a new CD at a higher rate. If rates go down, I'm okay. I've got 4 other CDs at higher rates. So you see how this makes life just feel a little bit better? The alternative to that is a bond fund, a fixed, high-quality bond fund, because basically the same thing is happening there. As bonds come due, as they mature, well, the fund is going out and buying longer-term maturities at whatever the prevailing rate is. So they're basically laddering for you so you don't have to do it. And the reason we say you should have somebody do it for you is because you do not discipline yourself very well when it comes to money. We are always, almost all of us, unless you've just really gotten this drilled into your head, the majority of people think they know more than the market, that my gut's telling me that something's going to change. You don't know. Your gut knows nothing. 855-935-TOM.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
And we talk a lot about how getting more help is really good for you. And even if you don't want to hire our firm, and many don't, you can still get some help with that crazy portfolio you have, or trying to understand what is necessary in a good retirement or portfolio plan, by setting up a meeting with one of our advisors, which includes Tom once in a while. Every now and again, he takes these. All you have to do is either call our office at 800-386-3004, or the easiest thing to do is just go online to talkingrealmoney.com and then click on the Meet an Advisor form, and that'll bring up an appointment setting form, which is just as easy as it can be. You pick the time, you get a meeting, and there's no cost, no obligation. Just go to talkingrealmoney.com.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future, so past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. To keep the lawyers happy.